So last week, one of my YouTube subscribers asked me to make a video about trade management because last week I made 5 videos and I think 5 out of 5 videos were about my entry into the stocks that I recently bought. So he said entry is fine, but what about exit? What about exit strategy? What about trade management? When to sell? So I thought let me make a video to discuss this in detail. So I want you to start taking notes as I speak through this video because as ideas come to me, I'm going to deliver those ideas to you in this video. So uh, this is very important based on experience. Whatever ideas are coming to me, I'm going to say those, note it down. It will help you in the long run. Okay. So this is about when to sell, which is a part of trade management. I have always said that you need to master 3 skills to become a professional, high quality stock market trader. Number one, stock selection. Number two, trade execution. Number three, trade management. If you look at the first 2 skills, stock selection and trade execution, it is a very scientific process. Okay, it is not an art, it is a science. Stock selection, trade execution. As long as the stock fits your criteria, you should be comfortable taking an entry. But when it comes to the third skill, trade management, that is where trading actually becomes an art. It is no more a science. Let me explain. So today is what date? Wait, let just a second. Today is 16th of December. Okay. Have a look at this stock. I had bought this stock. Dixon Technologies, very popular company in India. They manufacture mobile phones and laptops and things like that. So it's an electronics contract manufacturing company. So on 28th of November, I have put an arrow mark here. 28th of November, I bought the stock. Now the stock has started to go up. Today, you see there is a rising window, okay, which is a very powerful positive sign. Rising window means upside gap in Western technical analysis. So now the stock is up from my green line. My green line is 15817.75. So the stock is up like 20%. Let's check. From here till green line, it's up 18.59% from my buy price. Okay. So I bought somewhere between these two yellow lines. I have placed the green line here. I have made a detailed video about this stock last week. So you can check Dixon entry. In the title, I have mentioned why did I buy Dixon. So why did I buy on this day? I have given a detailed 25-minute discussion on that. Okay, so please watch that video. Come to this video because here we are talking about trade management. Coming back to the point that I made, trade management is where trading becomes an art. Now, why do I say that? See, the stock is up 19% from my buy price. So if you check here, if you see at this point, okay, now I've got multiple options here. Option number one, I can choose to sell all my shares. See, the market is live right now. It is 12 past 12. Okay, so it's been 3 hours in the market. The market is live right now. The stock, the numbers are moving. Okay, the stock is up 4.42%. So I have multiple options here. I'm trying to explain to you why trade management is an art and not a science. There are no rules here, there are only guidelines. So, option number one, I can choose to sell all my shares. Option number two, I can choose to sell 50% of my shares. Option number three, I can choose to sell 25% of my shares. Option number four, I can choose to sell some random percentage like 17% of my shares. Okay. Option number five, I can choose to move my hard stop loss to break even. Okay. Option number six, I can choose to move my stop loss to somewhere near this window or somewhere at the low of this candle or anywhere somewhere here. Okay. Option number seven, I can choose to stay in the stock as long as it remains above the 50-day simple moving average. Option number eight, I can choose to remain in the stock as long as it is above the short term moving averages. So the orange line is the 8-day exponential, purple line is the 21-day exponential. So I have given you 7, 8 options out of the infinite number of options that I have. Correct? Another option, option number 9, is to do nothing. Even doing nothing is a choice. See, when you buy a stock, you have a reason to buy a stock. But I am telling you that as a professional stock trader, you should also have a reason not to sell a stock. So currently, I have not sold any of my shares here. Now, I need to have a very strong reason as to why I am not selling the stock. See, not doing anything is also a choice. Okay. So I've just given you 8 or 10 different options that I have at this price. Okay. Now which one is right? Okay. Nobody knows. See, if I choose to sell all my shares and if the stock collapses, that was probably the best decision I made today, right? However, if I choose to sell all my shares and suddenly the stock doubles in the next 5, 6 months or 1 year, then that was probably the worst decision I made in my trading journey, correct? So, whatever decision I make, there are two sides to the coin. Whatever decision I make, there is a 50% probability that it is going to be right. So nobody knows what is going to happen next. We can only work with probabilities. We cannot work with certainties. So that is why I told you start taking some notes. So what are the different ways that you can manage a trade? Number one, moving averages. Start taking notes now. Moving averages. You could choose to be in the stock as long as it is above the short term moving averages. If it closes below these orange line and the purple line, which is the 80-day exponential and 21-day exponential, if it closes below the one of these lines, you could reconsider that position. You could have a relook at the fundamentals, technicals, comparatives. See, these numbers you have to keep checking every single day. You don't want to see deterioration in these numbers. Okay. Not that these numbers change every day, but keep an eye on these numbers. That is what I'm trying to say because you have a stake in the stock. Okay. So number one is moving averages. When the stock closes below these moving averages, you will have to reconsider. Now you might sell all, you might sell half, you might sell 25, but you have to do something. Okay. Or you just move your stop loss to break even. So just because the stock closes below the moving average doesn't mean that you sell all. It simply means that it's an alert. The stock is showing you signs of weakness. So for short term traders, these two moving averages are very good. In fact, there have been stocks like IRFC. If you see, IRFC broke out in November 2023. IRFC, India Railway Finance Corporation, and it started going up. It never closed below the orange line. And by the time it closed below the orange line, it had already given 86% return. 86% return from its buy price. If you want to see the stock, I will show you. Okay. Let me spend some good time with you here. You look at this. This was December. Sorry, it was not November. It was December breakout. Okay. I had bought this. So if you buy here, you see at this candle, it finally closes below the orange line. From this candle to this candle, not a single candle has closed below the orange line. It has been below intraday, but it never closed below the orange line, not even these candles. Okay. And from here to here, that's 86% return. See, from here to here, that's 84, 86% return, right? So these moving averages are very, very powerful. Coming back to Dixon. So just because the stock closes below the moving average doesn't mean that you sell. You have to start reconsidering the position. That is number one, moving averages. Number two, selling on strength or selling on weakness. So now you see strength in the stock. Okay, so the stock is up 19% from your buy price. If you want, you could choose to sell maybe 20% of your shares and keep the remaining 80%. Why would you keep a big portion of the stock with you and sell only a small portion? Why not sell 80? Why not keep 20, right? Why am I doing 20-80 and not 80-20? It's because the stock is fundamentally so strong that you wouldn't want to give up easily on that position. If the stock were fundamentally weak, then you would probably sell 80% and keep 20%. For fundamentally strong stocks, you sell 20 but keep 80. Okay, something like this. So 20 is an arbitrary number. You could choose 25, 40, whatever you want. But you could choose to sell on strength, partial selling. This is called as partial selling. And I am of the very strong opinion that in trading, partial selling is never a bad decision. Partial selling is never a bad decision because after you do partial selling, the stock could go up, it could go down. Okay. If it goes up, you kept some shares. That was a good decision. If it goes down, at least you sold something. Okay. So in trading, the partial selling quantity and timing, whatever you choose to do, it is a good decision. Okay. Partial selling is never a bad decision because you are taking some money off the table. You are de-risking the trade. Okay. So this is selling on strength. Then selling on weakness. Now, selling on strength means you are selling the stock here itself. You are not waiting for a close below the moving average. Okay. Selling on weakness means the blue line. Okay. Blue line is my mental stop loss. So I am watching certain levels, like this is point number 4 in the base, this blue line. If it starts to break that level on a 15-minute or an intraday time frame chart on high volume, I will start reducing my position size because the stock has started to show some weakness. Okay. Now, another way to sell on weakness is you see there is a rising window between these two candles. The high of this candle is 18034. The low of this candle is 18111. Okay, so there is a rising window. So if I draw a blue line at 18034, so let me draw a blue line here, 18034. Okay, so that's the low of the rising window. So this is a very crucial support level because an upside gap or a rising window becomes support. So that now becomes my second mental stop loss. Sorry, third mental stop loss. One is here at point number 4. The second blue line is here. See, there is a rising window here. So there is a second blue line here. So two mental stop loss and then the third mental stop loss. So tomorrow, let's say the candle closes like this, 4% up. Tomorrow, if it starts to break this level, okay, on a 15-minute time frame on high volume, I might start to reduce my position size. So I am partial selling because of weakness, not because of strength. Ideally, the stock should not break this level because it's a rising window. Rising window becomes support. Okay. Very important point. Selling on strength, selling on weakness. So always draw these pointers on your chart. Give them blue color so that it's a mental stop loss. It is not a hard stop loss in your system. Okay, hard stop loss is always at 8%. Don't play around with that too much. Give the stock some time and some room to fluctuate because it's a fundamentally very strong company. Look at these numbers. Go back to that video and see why I bought the stock. I'm not going to discuss that here because that's a long discussion which I made in that video. Okay. Number 3, and I hope you are taking notes here. Number 3, position sizing. Okay. Let's say you buy 10% of your position here. Okay. And you find another stock which you find is good and you want to release some cash from this particular stock because you think that it might come down. For some reason, you think that it might come down. Okay. So if you bought, let's say 10% and you want to cut down that position size to 5%, you sell the 5% position size, you are releasing some cash which you can deploy to some other stock. So just de-risk or diversify your risk or diversify your portfolio. Okay, so position size adjustment, okay, is very important. Some people, what they do is they take a huge position size, like people like Mark Minervini would buy 20-25% position size on this stock. And as it goes up, they bring it down to, let's say, more manageable 15 to 10% position size. By the time is up 20%. So they take some money off the table as the stock goes up and still maintain a 10% position size in the stock. So that is called position size management. Very advanced way of managing a trade. Even when this stock is breaking these blue lines, you are again you're adjusting the position size to reduce or control your risk. So when I sell into weakness as it breaks this blue line, assuming the window holds by today's close, when I sell into weakness, I'm doing nothing but managing my risk by reducing the position size while I am booking profits. Okay. Number 4, stop loss movement. See, my current stop loss is 8% below the green line. Green line is my average execution price. Now the stock is up 19%, and between my green line and the current price of the stock, there are two rising windows. See, there is one rising window here and there is one rising window between these two candles. Rising window or upside gap becomes support. So why not move the stop loss to break even? Okay. If I move the stop loss to break even, there is zero chance, virtually zero chance of me losing money at least on this stock. Correct? I will not lose money unless the stock gaps down so crazily that it opens below my average execution price. That's the only uh, way I can lose money in the stock if it simply gaps down like 10%, 15%, some crazy downside gap where it opens below my average execution price. If my stop loss is at break even. So I'm speaking fast. This is going to be an advanced video. That's why I say watch this video 2 3 times. Please take notes. Okay. So number 4 is stop loss movement. I can completely de-risk the trade by simply moving my stop loss to the break even, or I can move my stop loss to the low of this candle, which is the intermediate low here. Okay. And just relax. Even if the stock collapses, starts to come down, I will be out at a profit. So stop loss movement is another way of managing the trade. If I move my red line to the low of this candle and the stock continues to go up, I can continue to move my stop loss up. So movement of stop loss based on some technical level is also a good way to manage the trade. You don't have to manually sell the stock. If there is some major weakness, some country, some nuclear bomb or something, okay, some big event, global crisis happens, you would be out of the stock at a profit. Okay, that's a good way to manage the trade. Number 5, free rolling. Free rolling means, let's say you sell a portion of your position here, and on the remaining position you move your stop loss to break even, and the remaining position, let's say you sell 20% of your position size, the remaining 80% you will not sell till the stock closes below this blue line. Blue line is the 50-day simple moving average. This is a positional trade. This is not a swing trade. For a positional trade, you are investing in a comparatively, technically, and fundamentally strong stock. So free rolling means you sell 20-25% and the remaining 75% you are just free rolling. Means your stop loss is at break even and you will continue to be in the stock as long as the stock remains above the blue line. And there will come a time when after some days the blue line will cross your break even point. So in Mark Minervini's book Trade Like a Stock Market Wizard, there is a rule called as break even or the 50-day simple moving average. Okay, whichever is better. So you follow the blue line. As long as the stock remains above the blue line, you can continue to be in the stock. To give you an example, if you look at BHEL breakout that happened in, I think, November, December, same period. See this. This happened in November. Okay. The stock broke out here, nice base. Look at this. Look at the blue line. Okay. By the way, these are buy, partial buy, another partial buy. After it broke out here, it closed below the blue line here. So the blue line will keep you in the stock for months to come. Okay. So if I decide that on Dixon, I just want to follow the blue line, I don't have to do anything at all. I just have to relax. Every day before the market closes, I just have to come and see whether my blue line is breached or not. Okay. As of now, the stock is like 20-25% away from the blue line, which is a very good sign. It is called as cushion, okay, in the stock. So that is called free rolling. You sell a portion and on the remaining portion, you move your stop loss to break even and then you forget about the stock till it remains above the blue line. See, for a swing trader or a positional trader, you should never own a stock which is trading below the 50-day simple moving average. Okay. For a swing trader, never own a stock which is below the 20-day, 21-day exponential moving average. And for a positional trader, never own a stock in your portfolio which is below the 50-day simple moving average. These are some simple golden principles I'm giving you. Okay, this is the basics that you need to know as a professional trader. Okay, number 6, backstopping. What is backstopping? Well, backstopping means you are looking at some technical levels like this rising window, this rising window. You could choose to move this red line to the rising window at the close of this candle. That is called backstopping. So you're choosing a particular technical level which you don't want that level to be breached. If that level is breached, you would consider that as a weakness and you would immediately get out. So currently my automatic order is here. If I move this to this blue line, that would be an automatic sell order. That would be backstopping. Another way of backstopping is you just, whatever the price closes, you just keep your stop loss 5% below, and then you just continue doing that every day. Wherever is the closing price, you keep it 5% below. Wherever is the closing price the next to next day, you just keep your stop loss 5% below. So that's like your backstopping. You don't want to give up too much money that you have made on the stock. So you're backstopping the stock. It's different from trailing stop loss. See, in trailing stop loss, moving average is a very good way to trail a particular stock. So in a trailing stop loss, you might not move the stop loss. You might keep your stop loss here, the hard stop loss in your broking system. But mentally, you're trailing the stock. Mentally, you're looking at some of these levels. Okay. And if you find that those levels are getting, if those levels are broken on a close, okay, that too weekly close, then you would want to exit the stock. That would be called as a trailing stop loss. I consider trailing stop loss as a mental stop loss, not as a hard stop loss. My way of looking at a trailing stop loss is very different from what you must have read in books. Trailing means I'm watching the stock price very closely. Okay. And I'm trailing the stock. Okay. If it breaks some crucial technical level, I will be out of the stock. Okay. But backstopping means you're placing a hard stop loss. Your backstopping means you're stopping there. Okay. Then news events. News events means what? See, now this stock is comparatively technically fundamentally strong. You see a rising window. So whenever there is some upside gap or some extraordinary push, there is usually a reason to these things. Okay. Nothing happens in the market for no reason. So today in Economic Times, I was reading there was a news that Dixon, which is an electronics contract manufacturer, they signed a binding agreement with Vivo India. Vivo India is a subsidiary of a Chinese mobile phone manufacturer. So there is a joint venture between Dixon and a subsidiary of Vivo company, and that joint venture will manufacture mobile phones in India for the Vivo brand. They will be sold under the Vivo brand, and the Dixon company owns 51% stake in that joint venture. Isn't that a positive development? Moreover, in that same news article, it was written that Dixon not only manufactures phone for Vivo now, it also manufactures mobile phones for Samsung, I think Oppo, I think Google, Motorola. These are clients of this company. Okay. Isn't that a good sign? Okay. So when you see news events like that, and when you see price confirmation of news events like that, in a position that you hold in your portfolio, it helps you connect the dots. So the stock is fundamentally, technically, comparatively strong. News events that are coming out in the market are strong, positive, optimistic. The analysts are optimistic about the stock. There was another news article where Dixon was mentioned, where analysts are recommending the stock. Okay. So when all of these dots, when you start to connect together, you as a professional trader should be reluctant to sell the stock, to give up on your position. If you are nervous, sell half, but keep half. That is what I'm trying to tell you. Okay. Because when you sell something, you raise cash. Now, the problem is where to deploy that cash. Can you find a company which is doing better than this company? That's a problem. So, Mark Minervini has said in his book that the best stock you can buy in your portfolio is a stock that you already own. So, he was talking about pyramiding. Okay. So, I bought the stock once here. This was my buy price. I have also made a video on this to explain why this trade is called as a pivot failure reset. So I bought it here, I bought it here, that's pyramiding. But this position I had sold somewhere here. I have also made another video on this. So on the same stock, I have made like 4 videos now. So you can go back to my YouTube channel and check all those videos and see how I am tracking this company, why I am so interested in this company because of these numbers. Okay, these are fabulous numbers. Leading, these are numbers of a leading stock. Okay, market leading stock within the industry group as well. Okay, so news events. So when news events and all these dots you combine, when everything fits together, and all of that is confirmed by actual price action and volume action. Look at this volume, cross the blue line. Okay, more than 1 million shares will be traded probably by the end of day today. Okay, good sign. That's a very good sign. So when all of these things come together, try to hold on to that position as long as you can. Don't give up on that position so easily, because you have made a lot of effort to identify a buy point. A lot of study and analysis has gone into buying the stock. Okay, so why would you give up on that position so easily? So what if it collapses? Okay, if it collapses, fine, but at least you made the right decisions based on the information you had available at those points. Tomorrow the stock could collapse 15%, right? But that is not important. What is important is, given the current information you have, what was the decision you were making? What were you thinking? Okay, that is more important. Now, if it collapses 15%, you should be prepared for that event as well. That is why I have made these markers, the blue lines. Okay, these are mental stops. So 5, 6, 7, 8. Point number 8 is mental stop loss, which I have already discussed with you. Mental stop loss is a stop loss level where you mark a blue line on the chart and you watch that level closely on a 15-minute or a 5-minute chart. If the stock is closing below the blue line on high volume or extraordinary high volume, then start reducing your position size. Don't give up on a stock which is fundamentally very strong. Don't give up on a stock which is 20% above your buy price. Don't give up on a stock which is 25%, which has a 25% cushion on the 50-day simple moving average. Okay. These are extremely golden rules. So that is why I'm telling you, watch this video 2, 3 times, take notes. Okay. Whatever is coming to my mind, I am just blurting out. But this is golden knowledge. Okay. If you understand what I'm saying. Last is number 9, trailing stop loss. Well, you can trail the stock either with the help of swing lows like this, or through moving averages, or through technical levels. But trailing stop loss is where you are trying to optimize your gain. Okay. So you are trailing the stop mentally. Okay. Of course, if you want to move the red line to the low of this candle, you can do that. That is also like trailing the stock. Trailing stop loss can be looked at in a multiple different ways. Okay. Another way, last way, 10th way to manage the trade is pyramiding. Pyramiding means I bought the stock here. By the way, pyramiding is a video that I published yesterday. So you can check that entire video where I show you examples of 4 stocks: BHEL, Tata Investment, Dixon, and Cochin Shipyard. I discussed 4 stocks in yesterday's video, and it was dedicated to pyramiding. Okay. So pyramiding is another way. So you can buy the stock here at a pivot failure reset point. Then you buy another stock here. After the election results, the stock starts to go up. Another price tightness, you buy another stock on this day, which is basically a squat candle. Hold on to the position, it starts to go up, creates 2 rising windows along the way. Okay, very, very positive sign. So pyramiding means adding to your existing position at appropriate points. Like if you buy more shares here, that's nonsense. That is not the way to buy a stock. Okay, that is not the way to do pyramiding. Pyramiding is of 2 types. You need to buy at a base breakout. So if you buy at a particular base, wait for the next base to develop and buy that breakout. That is pyramiding, scaling into the stock. Or you wait for a pullback to the moving average and you buy additional shares into the stock because it bounces off the moving average 21-day or 50-day, but you do that only in a confirmed uptrend. Okay, so those are 2 ways of pyramiding. If you buy a stock, buy more shares here, you are taking unnecessary risk. Like some people look at the upside gap and they start buying here. No, that's not correct. That's not how you buy, because that is not a low risk point. This is a low risk buy point because you have price tightness here. From here, the stock can either go up or it can go down. So you have a very tight range of risk here, 2 to 3% risk. Okay, but here, if you buy here, the stock collapses 10% the next day. I mean, don't do that. Okay, so 10 points. Moving averages, number 1. Number 2, strength or weakness. Number 3, position sizing. Number 4, stop loss movement. Number 5, free rolling the trade. Number 6, backstopping. Number 7, news events, connecting the dots. Number 8, mental stop loss. Number 9, trailing stop loss. Number 10, pyramiding. So you have so many options. So that is why I say trade management is an art. It is not a science. There are no rules here. There are only guidelines. And one thing I forgot to tell you, which is point number 11, is the market condition. Suddenly, if the overall general stock market index turns gives you a confirmed downtrending signal, then you should be out of the stock. Like 75 to 80% of your position should be closed because you are dealing with a declining overall stock market where maybe the foreigners are pulling money out of the Indian stock market, which happened in October of 2024. Okay, lot billions of dollars went out of the country. Okay, that's not a good place to be in the stock market. So 50 to 75% of your portfolio should be in cash in such cases. So when that happens, all of these 10 rules you should set aside and raise cash. Okay. So there are more ways to for trade management. How many ways can I tell you? You can go to the weekly chart and manage the stock from the weekly chart as well, rather than looking at the daily charts. Okay, so you watch the stock week after week and then you take a decision accordingly. So multiple ways for trade management. That is why I say trade management is an art. Don't ask me rules. Don't tell me to give you rules. There are no rules in the stock market. At the max, I can give you some basic non negotiable rules for stock selection and trade execution, but I cannot give you any rule for trade management. Okay. So this is Dixon. If you look at Time Techno, which I bought last week, again, on this also I made a video. See, this stock has a shooting star. Now, the strategy that I use on this stock will be very different from the strategy that I use on Dixon because this stock has 40% growth. Dixon has got 261% growth. So my trade management decisions are based on the personality of the stock or the character of the stock. Another stock which I made a video last week. This is going even crazy. Okay, it's like 5-6% up today. Okay, I bought it on this day. Okay, watch the video why I bought this stock on this day and what are the rules that I had violated in my own trading system. But I managed to get a half position in the stock. Please watch my videos of last week. Very important before you watch this video. Okay, and yeah, so that's what I wanted to cover in this video. So my trade management decisions are very subjective. I don't know what I'm going to do with a particular stock. It depends on the personality or the character of the stock. I will not apply the same rules on all the stocks that I own in my portfolio. It depends on the situation. It is case by case. Plus, I will be watching these numbers to take decision on what I want to do in the future about a particular stock. Selling doesn't mean I sell all. I could choose to sell half or 25%. Thank you so much for your time. Have a fantastic day today. Hope this answers your question on trade management. Okay. Thank you so much. Take care.